Section 7 of a business plan is the financial plan. This infomercial will tell you all about what is a financial plan. The financial plan section is the most important section of a business plan, especially if you need debt financing or want to attract investors. The financial plan has to demonstrate that your business will grow and be profitable. To do this, you will need to create projected income statements, cash flow statements, and balance sheets. For a new business, these are forecasts, and a good rule of thumb is to underestimate revenues and overestimate expenses. Now let's look at the income statement. The income statement can also be referred to as the statement of operations or the statement of profit and loss, which is sometimes shortened to P&L. When you think about all of the transactions that a company records during a period, you can see why it's necessary to have a statement that's dedicated just to the operations of the business. While in theory, it could be possible to record everything on the balance sheet and to retain the earnings, we realize that really it requires its own statement to keep track of all the income, all of the expenses, and all of the resulting profit or losses. Let's look at the income statement in more detail. The income statement starts at the top with revenues. Revenues can also be called sales or turnover. It represents the income that a company receives for selling goods or services. Below revenues, we have direct operating expenses such as purchasing inventory. This line is often called cost of goods sold or cost of sales. This is the first expense line on the income statement. After deducting cost of goods sold from revenue, we arrive at our first subtotal on the income statement, referred to as gross profit. Gross profit is equal to revenue minus cost of goods sold. If we take the gross profit and divide it by the revenue, we calculate the gross profit margin. Next on the income statement comes the indirect operating cost. This includes things like research and development, administration, selling, and distribution. Several of these line items may be grouped into one, sometimes called selling, general, and administrative expenses or SG&A, or just general and administrative costs, G&A. If we take revenues and deduct the direct operating cost, and then deduct the indirect operating cost, we arrive at the next subtotal, operating income. The terms profit or earnings can be used interchangeably with income. Operating income is often referred to as EBIT, which stands for EBIT. Earnings before interest and taxes. Below the operating income line on the income statement, we can then deduct the cost of debt financing. This includes interest expense and bank charges. After deducting the cost of debt finance, there is often another subtotal for earnings before tax. Below that, taxes are deducted, and finally, we arrive at the net income, the bottom line. Net income can also be called net earnings or net profit. This is the bottom line of the income statement, which then feeds into the retained earnings account on the balance sheet.
Cash flow projection is a breakdown of the money that is expected to come in and out of your business. This includes calculating your income and all of your expenses, which will give your business a clear idea on how much cash you'll be left with over a specific period of time. Understanding and predicting the flow of money into and out of your company, on the other hand, can help entrepreneurs make better decisions, plan ahead, and avoid a cash flow crisis. If your cash flow projections indicate that you will have a higher than normal costs and lower than normal earnings, it may not be the best time to purchase a new piece of equipment. If, on the other hand, your cash flow projection indicates a surplus, it may be time to invest in the company. Accounts receivable and accounts payable are two concepts that must be grasped in order to properly create a cash flow projection. The term receivables refers to the money that a company expects to receive in the form of customer payments and deposits, as well as government grants, rebates, and even bank loans and lines of credit. Accounts payable, on the other hand, refers to anything that the company will need to spend money on in the future. Payroll, taxes, payments to suppliers and vendors, rent, overhead, inventory, and the owner's compensation are all included. A cash flow projection is a breakdown of anticipated receivables versus payables. Finally, it gives a snapshot of how much cash the company expects to have on hand at the end of each month. Estimating expected cash flow projections can aid in the growth of your business. There are numerous advantages to projecting cash flows. Examples of these advantages are having the ability to predict cash shortages and surpluses, compare and observe business expenditure and income over periods of time, calculate the impact of a business change, an example, hiring an employee, demonstrate to lenders your ability to pay on time, and lastly, check to see if any changes, adjustments are required, an example, cutting expenses. Keep in mind that cash flow predictions will likely never be perfect. If done incorrectly, your anticipated cash flow analysis can be time-consuming and costly. However, you can use your projected cash flow as a tool to help manage cash flow itself. The bottom line is, your cash projections give you a clearer picture of where your business is headed, and it can show you where you need to make improvements and cut costs. If you're ready to start calculating projected cash flow for your business, start gathering some historical accounting data. These are the 5 steps to calculating a projected cash flow. First step, determine your company's cash at the start of the month. You must subtract the previous period's expenses from income to determine your cash from the beginning of the month. The next step is to estimate how much money will flow into your company over the next period. Incoming cash includes things like revenue, sales made on credit, loans, and more. Looking at trends from previous periods might help you project your future cash flow. Make sure to account for any differences or influences from previous periods. Step 3. Estimate expenses for the following month. Think about all of the expenses you will pay next month. Consider the cost of raw materials as well as rent, utilities, insurance, and other expenses. Step 4. To calculate your business's cash flow, subtract your estimated expenses from your estimated income. After you calculate cash flow, you need to add it to your opening balance. This will also give you your closing balance. Your closing balance will carry over to act as your starting balance for the next month. To complete the next month's projected cash flow, repeat from step 1 using the new starting balance. Here is an example of a cash flow projection. Now that we have learned the importance and how to make a cash flow projection, let us move on to the balance sheet. Welcome! Today I will introduce to you the balance sheet. A balance sheet gives a statement of a business's assets, liabilities, and shareholders' equity at a specific point in time. They offer a snapshot of what your business owns and what it owes, as well as the amount invested by its owners. A balance sheet tells you a business's worth at a given time, so you can better understand its financial position. The following are the items contained in a balance sheet. The assets section of a balance sheet breaks down what your business owns of value that can be converted into cash. Your balance sheet will list your assets in order of liquidity. Liquidity is how easily an asset can be converted to cash. There are 2 main categories. Current assets can be easily converted to cash within a year or less. The first is cash and its equivalents. These are your most liquid assets, including currency, checks, and money stored in your business's checking and savings account. Marketable securities, investments that you can sell within a year. Accounts receivable, money that your clients owe you for your services that will be paid in short term. Inventory, for businesses that sells goods, inventory includes finished products and raw materials. Prepaid expenses, things of value that you've already paid for, like your office rent or your business insurance. Long-term assets are assets that cannot be converted to cash within a year. They can be further broken down into fixed assets. It includes property, buildings, machinery, and equipment like computers. Long-term securities. These are investments that cannot be sold within 1 year. Intangible assets. These are assets that are not physical objects, such as copyrights, franchise, agreements, and patents. The next section of a balance sheet lists is a company's liabilities. A company's liabilities are the money that the company owes to others, including the recurring expenses, loan repayments, and other forms of debt. Liabilities are further broken down into current and long-term liabilities. Current liabilities include rent, utilities, taxes, current payments toward long-term debts, interest payments, and payroll. Meanwhile, long-term liabilities include long-term loans, deferred income taxes, and pension fund liabilities. The last section of a balance sheet is called a shareholder's equity. This refers to the amount of money generated by a business, the amount of money put into the business by its owners, and any donated capital. Shareholders' equity is your net assets. On your balance sheet, it's calculated using this formula. Stakeholders' equity is equal to total assets minus total liabilities. It is important that a balance sheet must always be balanced. A balance sheet is divided into two sections, with one side representing your business's assets and on the other showing its liabilities and shareholders' equity. If the total value of your assets is equal to the combined value of your liabilities and equity, then your document is said to be in balance. This is represented by the formula below. Assets is equal to liabilities plus shareholder equity. A balance sheet is an important financial statement that gives a snapshot of the financial health of your business at a point in time. A balance sheet is important because it provides the following insights about your business. Liquidity. By comparing your business's current assets to its current liabilities, you'll get a clear picture of the liquidity of your company, or how much cash you have readily available. You always want to have a buffer between your current assets and liabilities to cover your short-term financial goals, with assets always greater than liabilities. Efficiency. By comparing your income statement to your balance sheet, you can measure how efficiently your business uses its assets. For example, you can get an idea of how well your company is able to use its assets to generate revenue. Leverage. Your balance sheet can help you understand how much leverage your business has, which tell you how much financial risk you face. To judge leverage, you can compare the debts to the equity listed on your balance sheet. This is an example of a balance sheet.
When can you say a business is good or not? Quite simply, it's good if the money earned is more than the money spent. However, a business has to spend on long-term stuff and short-term stuff. For example, if your business spends on a new shop, this is a long-term thing. If it spends on the cost of apple because you're selling apple juice in a juice shop, this is a short-term thing. When we say that a company breaks even, we're generally only comparing money earned against the short-term stuff like the ingredients which go into your apple juice, the salary you might pay to your apple juice maker and shop manager, the insurance and rent for your shop, advertising for your apple juice, taxes for your business, and other similar things. When you earn enough from selling apple juice to pay for the short-term things, we may say that a company has reached its break-even point. When you're not selling enough apple juice and not earning enough to pay for the short-term things, your business is said to be losing money. When you're selling more than enough apple juice to earn more than enough money to pay for the short-term things, then this extra earnings is called profit. So, when you're at a break-even point, you're not in a good situation, but also not in a bad situation. You have no profit, but also no loss. If you're still starting out in your business, you of course want to target reaching break-even point so that you don't lose money. Break-even analysis is when we try to find out how much sales we need so that your business can break even. But after a while, you want to be better than break even. You want to have some profit as well. So, when we try to find out how much sales we need to be profitable, do we still call this break-even analysis? Normally, no. We now call this cost volume profit analysis, or CVP for short. With this cost volume profit analysis, we try to find out how much sales we need to reach a certain target profit. The financial plan is the process of estimating how a business will afford to achieve its goals and objectives. It is the most important section of the business plan. By understanding income statements, cash flow statements, balance sheets, and break-even analysis, we can have a grasp on what a financial plan looks like and how it works. That is all from us. Thank you for listening.